Bonds versus stocks. What are the differences? What are the similarities? What are the pros and cons to each? Like and subscribe if you enjoy. A stock is a share or stake in a publicly traded company. A stock has a certain value based on the profits, the growth, the demand of the company, and so much more. The higher the value of the stock, the higher the price and demand there is. When you own a stock, you are a part owner in the company. Most of the time, you don't have any influence. The only influence that people have when they own a stock is when they have 5, 10, 15, 20% of the shares in the company, such as Jeff Bezos with Amazon, Warren Buffett with Coca-Cola, Elon Musk with Tesla. A company will issue stocks or part ownership in the company to raise capital in exchange for part ownership in the company. The shareholders, or the person who bought the stock, is entitled to get their money back, plus whatever the stock value grew at or shrunk at by that point. A bond is a fixed income instrument that is issued by the government, state, federal, provincial, municipal, whatever level of the government, corporations as well, to fund operations and projects. A bond always has a beginning date and end date. This is not the case with stocks, however, because you can invest in stocks when you're 20 and still be holding them when you're 80. The majority of the time when you invest in bonds, the longest amount of time you can hold them is 30 years. There is a time limit to these, so be careful when you're thinking of retiring off of them. Bonds are the complete opposite from stocks because whenever the interest rates fall, the bond prices go up, and vice versa when interest rates go up. The risk of these two investments is almost completely opposite from each other. Bonds are the safest option when it comes to government-issued bonds because the government can always print more money to pay people back, as well as it has a lot of income from tax. When people don't want to invest in companies, they look for corporate-issued bonds because there is a set amount of money it was bought for and interest rates that you and the company agree to pay and receive. Stocks are on the complete opposite end of the spectrum. A stock is not valued based on a contract basis, but on a performance and demand basis for the company. When you invest in a company through stocks and shares, you are risking every single penny from your investment. This is why I say a lot, only invest what you can afford to lose. The one benefit to this is that you can only lose what you put in, meaning that you cannot lose $5,000 if you invested $1,000. This is why it's not one of the most dangerous investments. Stocks are high risk, high reward. Just look at Warren Buffett. Pros and cons to bonds. Pro number one is how most bonds have a high level of stability and safety. Compared to other investments, bonds are safer because the fluctuations in price are at a minimum. A large factor is because when a bond is issued, they are issued with a certain interest rate and an end date that they will be bought back for. Especially when it comes to government-issued bonds, the value of bonds hardly ever fluctuate. Pro number two is how bonds are able to beat inflation with their interest rates. The average inflation rate is in between 1 and 2%. The average bond rate is in between 2 and 3%. This means that they are able to beat inflation every year while giving you some profit. The interest rates are stable and consistent, meaning that you know what you're in for when you invest in bonds. Bonds are a great place to hold your money when you just want to beat inflation and not want to make major profits. Let's say you're saving for an investment or a rental property or things like that. Bonds are a great place to put your money. Con number one is how the returns are low, meaning that it takes more money to invest to create a lot of returns. Many people opt to go for stocks because of the higher return rates. However, bonds are much safer. Con number two is how you are much more exposed to interest rates and failure than if you had invested in stocks. When you are making money from stocks, you are doing so through interest rates. If interest rates were to go down, then that will impact your portfolio and earnings negatively. However, this could be a good thing because if interest rates go up, then you will be making more money by buying bonds. Pros and cons to stocks. Pro number one is the potential earning and profit you could make. The stock market has an average return of 7 to 10% each year. However, this is not always the case. If you pick a winner, then you could have extreme growth. Look at Amazon, for example. The people who had invested $1,000 into the stock when it was at 50 cents would have made over $7.3 million. If you had invested in another company, you may have done well, but you would not have made that $7.3 million. Pro number two is the diversification. There are so many industries and places where you could put your money. There are the banks that grow slowly and stably. There are tech stocks that grow at a rapid pace. Tesla. Then we have the sectors of the markets that are working towards changing the world, like SolarCity and other renewable companies. Con number 1 is the risk. 9 in 10 businesses fail. This means that there is a lot of risk. Just because there are companies on the stock exchange and the S&P 500 does not mean that they'll last forever. So there is a risk that it will fail. When a business starts to fail, you will lose nearly all of your investment. This also means that you're going to have a roller coaster of emotions. Con number 2 is that it takes a lot of time to gain a fortune with stocks. This means that you won't become rich right now, tomorrow, or even in a week. This is why Warren Buffett became a billionaire after 56. Thanks for watching. Comment down below if you want me to go into a specific investment. Like and subscribe if you enjoyed, and I'll see you next week.